Good morning, ladies and gentlemen. Well, for some, the big event of the week was the melt up in the American equity market, but for me, the big event of the week was the dollar. This is a chart of the dollar monthly going back to the early 70s, as you can see. And so it's always helpful to go back and revisit certain inflection points in history to see what caused them. And to me, the next inflection point in American equities will be caused by the dollar. What do we know about the dollar? We know that everybody was bullish of it simply because they thought American interest rates will go higher relative to European rates and world rates. And secondly, everybody thought the American economy would go great guns with Trump in there, and therefore the dollar would be a buy. Our position was diametrically opposite. We always thought, ever since Trump was elected, that the dollar was going to go down because Trump wanted a lower dollar, and a lower dollar is the only way Trump can achieve his electoral promises of bringing back industrial jobs to blue-collar states. The guy in Michigan is not all of a sudden going to go to Palo Alto and become a programmer. He was a metal beater and he remains a metal beater. The only way you can bring a competitive job back to a metal beater is by reducing the real level of his wages down to his competitors' level, which is a hell of a lot lower than even at the moment. And the only way you can do that is by having a significantly lower dollar. This is now where I think we find ourselves. We find ourselves in a period very similar to 1987, when the dollar was hugely overvalued. So don't look at the spike, but look at what happened to the equity market when the dollar actually stabilized and stopped going down. Because it can be very well argued that most of the move in the early 80s in the equity markets, which people called the melt up, was in fact caused by the dollar coming lower, and therefore American equities being cheaper and cheaper and cheaper to the world relative to other equities. This is probably something that not enough people look at, especially in the States. We want to see what the relative value of equities is around the world. We are now in a much more globalized world, and therefore the value of American equities is measured against a world benchmark. So, what can happen here? And as we warned last week in fact, a couple of weeks ago, in our warning about what could really happen, what are the big macro dangers for 2018, is that the dollar now starts coming down quite aggressively, probably losing at least another couple of percent, if not 4 or 5%, and comes back all the way to where it was when Obama took over. Trump wants something diametrically opposed to Obama. He wants a lower dollar. He wants manufacturing jobs back in the United States. This is the same chart, just on a weekly basis. As you can see, the trading has been very orderly. There are no moves beyond the Bollinger Bands. There is nothing vertical like this. It is now probably going into an accelerated period lower. And where would we think it would stop? Well, the first obvious target would be this support line, which next week is somewhere around the 90 level, probably just lower, and then 88.66, followed by the 85 level, which has caught it many times before. That is a move of another 4-5% all the way down, which implies that even if equities did absolutely nothing, you still have another 100 points of upside. And it will be now very helpful to actually look at the performance of the relative performance of equities over the past few months, and try to extrapolate the next few months and weeks. Before we do that, I can't resist showing you this chart. This is a daily chart of the stocks, so the European equities. Nobody can say that this is actually an unruly chart. It is a very nice uptrend. This is the 200-day moving average that you can see. The market is basically being supported by the 200-day moving average, and certainly not exuberant in terms of price or deviations from either the Bollinger Bands or any mean or any moving average. This is a very nice trading market in a nice reasonable slope of uptrend, being supported. Nothing fantastic about it. Well, this is that same market in dollar terms. You can see that we are now at the same level we were at the beginning of 2017, i.e. nothing has moved in the relationship between the chart I've just shown you of Stocks 50 and the S&P in dollar terms. So the S&P itself is actually trading in a very orderly manner if you take out the FX component, which is the reasonable thing to do. You're trying to compare apples to apples and oranges to oranges. So the S&P is absolutely not at the moment still in some wild spirit area. It is trading very much on a par with European markets if you take out the dollar. Now that has some implications. The implications that all the people that think that we have started a ridiculous melt-up are all wrong. But it also implies that when the melt-up, the unreasonableness does happen, we will be able to spot it using this relationship, and we will be prepared to take advantage of it. Back to our monthly chart of the S&Ps. And people ask me, why am I not more aggressive? Why don't I sell it, etc., etc.? Well, the answer is that I will buy a tactical put when I think the market is overbought, but I do recognize that being short of S&Ps at any stage is actually being long of dollars. The trend in DXY, unless it stabilizes, will ensure that this goes higher and higher and higher, and in fact just by going higher it's actually going nowhere in terms of valuations against other equities. What it is doing, of course, is pushing out and pushing up the multiples at which the market trades, because American corporations, let's take out the very few that have significant foreign earnings, the core ones in the S&P 500, say the 300 bottom of the S&P 500, have very little earnings abroad. So the fact that the dollar is cheapening is of absolutely no consequence to them. You have a situation in which their valuations are being pushed out and out and out to ridiculous multiples, and that situation will become unsustainable at some point. Nobody can really tell at what point, but because it's like stretching an elastic, and here we have signs of that elastic being stretched. Can it go another 5%? Absolutely. We just showed you that the dollar could go down another 5% without any problems. If European equities and world equities are actually very stable, or go up 1 or 2%, we could have a 7 to 10% move in the S&Ps without any problems on the upside still. But at some stage, that elastic will snap back with absolute ferocity because mathematically it has to. I think it's very important to have a quick word about volatility. Now, this is a chart of XIV, so the inverse of VXX. So as the price comes down, volatility goes up, and in reverse, i.e., as the price goes up, volatility comes down. Over the course of the past week, the rate of ascent of this contract has gone flat. We've had a very large move in the underlying, in the equity market. We've had almost no move whatsoever in volatility. It started the week almost, it ended the week almost where it started it. These are the first signs of a trade which a lot of people are beginning to put on, which is long calls in volatility and long calls on the market. Basically saying, it's another way of saying that before the top, volatility goes up, which makes sense because, as I've always told you, nobody's going to sell you cheap puts at the top. So what we are having here is the first signs of dislocation between volatility and the market that it's measuring. It is absolutely normal that, as we told you, as the dollar does its thing and as ES melts up, that volatility should start actually turning before this contract XIV should start turning before a top in the ES. That is something that you have to keep on looking at very closely because it will probably indicate when the top in ES will take place much better than watching any other indicator of ES or SPX. Let me show you one more chart which indicates exactly what I've been telling you so far. This is the Dow over the S&Ps. So basically every time the spread goes up, the Dow is returning more than the S&Ps. We all know that the Dow 30 companies are actually much more international than the average of the S&P companies. And while the dollar was going up, you have the S&P performing better than the Dow, and ever since the dollar has been going down, you have the Dow performing much better than the S&Ps. Absolutely makes sense. There is absolutely nothing wrong with this kind of performance, but we are now already the Dow over the S&P discounting levels at which it was back in 2012. If we now superimpose that with a chart of the dollar index and we go back to 2012, we have the market here. Do we see the difference? We have the market in the States already anticipating a dollar which is a good 8 percentage points lower than the real dollar is, which to me shows that there's much more room for this dollar to come down, certainly down towards the 85 area. And I would say that the spreads are already showing an acceleration of this trend over the weeks and months ahead. We have to be very careful of not becoming bearish of equities for the wrong reasons. There is absolutely no chart of all the charts that we follow that says there is any reason for risk off. Whether it's SPY, TLT, whether it's any of the 37 indicators we follow, not a single one is saying that we are in a risk off period. They will tell us when that time comes, but that time definitely is not now. Given that we are not in a risk-off period, these next few charts are actually even more extraordinary. We are in a risk-on period. uh, Equities should be really outperforming everything and anything, and here we have equities over commodities, so SPY over the DBC ETF. Well, that relationship actually topped here in June of last year. So since June last year, that's a good 6 months now, right? We have had we've had commodities as the top performer, and we are now at a very, very interesting junction. We are at the 200-day move. Yes, actually, this is a weekly chart. We're at the 52 week, so we're actually at a very, very important junction. If now commodities start coming lower than this moving average, we will have a really important technical signal that we could have the first signs of possible inflation being shown by the commodity market. And here is that same chart, but on a daily basis. This is actually the uptrend that we've been in since 2011. And this is a very important level in the relationship between SPY and DBC, this 1571. This is a major top. We tried it for a day, didn't like it, came back, and then finally pushed through it in 2017 and held that range for ever since basically the first quarter of 2017. We're now below the 200-day moving average, which is still flattish to pointed upwards. If we break that level, I think we will be ready to say that commodities are now in trend against all asset classes. And when commodities get in trend, that is just a huge move, whether it's up or down. Commodities don't piss about. They just go. They just double and double and double. That is going to be a trend and a half when it gets going. I've seen on my stream and in other places a lot of talk about gold, and this is basically a chart of the S&Ps over gold. Not very exciting, is it? These are all very normal retracements. The 200-day moving average is still a long way below. This is the 50-day moving average. It is, I see absolutely no reason here to get bullish of gold, certainly not over equities, even though the dollar is going down and has been going down. There has been absolutely no sign that gold has done anything out of the ordinary. It is probably a better sell than a buy. Commodities in general are performing much better than precious metals, and that absolutely makes sense because commodities, metals and energy and so on have a reason to go up, and that reason is called an economy which is working much better worldwide. I've said it once and I will probably say it 1,000 times. The only thing which is going to kill the equity market is going to be the bond market. The bond market has always slain the equity market, whether it was in 87, whether it was in 2000. The bond market at the moment is just not high enough in terms of yields to do any lasting damage to equities. To do that, we need to break these highs around 260, 262, 264, and start accelerating away. While the 10-year is below that level of 264 and not accelerating higher, I very much doubt that the bond market is going to dent the performance of equities. The relative importance of this area cannot be minimized. Every time we have gone below 250, we have actually gone significantly below 250 to around 237, 233. So as long as we keep above the 250 area, all we're doing is we are getting enough momentum to break that 264 area. That might take another few weeks, but we do think we definitely attack it, and we definitely go through it. I'm often asked why the 10-year note in the States is only yielding 250. Why isn't it yielding much more when the economy is doing so well? Well, the answer is always the same. The answer is that everything in life is a spread, and everything is relative. Relative to bunds, they are yielding a huge amount. We have bunds now yielding 50 basis points. Naturally, money is going to flow out of Europe and into European fixed income. Into American fixed income. Don't forget, basically on a dollar hedge basis, don't forget that the Europeans have a humongous pool of bonds. Bond funds are the go-to investment of Europeans. The percentage of equities they hold is much lower than the typical American holder, and therefore there's an inexhaustible supply of money which can be sold in Europe and to buy the States. This chart actually tells us that we are at an extreme. 50 basis points has capped for the past year and a half. So now if we were to start trading sideways for a couple of weeks and building the momentum to go up towards the 70s, that will be the impulse that we will need for higher yields in the States as well. At the moment, the States is being basically constrained by Europe, which is being constrained by the ECB. If we get some more hawkish tones from the ECB, which personally I doubt, certainly not in the first month of the year, although I know what the rumors have been and I know what the response has been, but all that has really done is moved the market 5 basis points and moved the 5/10s another 2 basis points. That is easily undone, and that is easily denied by Draghi at the next press conference. I wouldn't get too excited by it. What we do have is the potential here to wait for the Draghi press conference, and if he does not deny the fact that a lot of ECB members want higher rates sooner, then we can have a move up to the 70-75 area without any problems in about 3 weeks time. It is certainly an idea if we get back down towards into the low 40s in the bunds to start buying yield calls, i.e. price puts, just in case we get an unexpected announcement out of the ECB confirming. Otherwise, we're still stuck in this range. Yes, the weekly Bollinger Bands have started moving, expanding, which is a sign that we'll get a move, but probably not in the next 2 or 3 weeks. I have been asked to comment on the Bund BTP spread. Unfortunately, this is the best chart there is of the yield that I can find. I've got a price chart of the differences between the price of the Bund futures and BTP futures, but that doesn't take account of the varying basis. This is probably the best chart. This is a yearly chart. We have very good support here around the 135 area. But the problem with the Bund BTP, and the reason why I've been trading it far less, is that really it all depends on when the ECB does its QE. They come in at some stages and buy the BTPs, which forces the yield in BTPs down, and then at a different time they come in, they buy the bunds, which forces the spread back out. It's a complete mess. What we can say is that certainly should it get back down towards the 105 level, which was its historical low, it would be a no-brainer to buy. Even around the 120 level, it is a no-brainer to buy. If one looks at the fundamentals and one looks at the politics of it, I don't think that that is really all that important at the moment. What is far more important is that at some stage QE ends, and just when QE does end, the supply of bunds will still be the same, i.e. almost nothing, while the supply of BTPs is going to be huge, and continue being huge. And therefore, if one can pick it up at sub 125, I think it's a kind of position that you want to hold and keep on rolling for a long time. We can now go to our biases. We are still sellers of 5 and 10 years and bunds and bobbles, especially the bobble now. We will tweet the levels when we get there. They're still a long way away. We don't think it's prudent to sell the market at these levels. The rallies are the places to sell it, because the speed at which the market is going up in yield, down in price, just does not warrant chasing it. We showed you the spread between commodities and S&P, and here we have the what I warned about last week. Volatility is certainly something that is not going down. It is certainly stuck compared to the price of ES, and that makes a hell of a lot of sense. The super cycle, we still think, is going to be the thing which is going to make money over the course of the next few years. And we have now the DX breaking down and certainly looking for 90. We are actually probably looking for 85 over the course of the summer. So not much has changed. It's just an acceleration of all we thought, which is the dollar going down and driving everything else. Thank you very much indeed, and speak to you next week.